Hi, Maz Insiders. It's Jed Maslowski of Maz Income Planning Services. Thank you for joining me for today's lightning fast lesson. Today we're talking about Index Universal Life Insurance, or IUL. This will be video 404 covering the various types of permanent life insurance. Because IULs are so expansive, we'll be posting our first deep dive video going into much greater detail about them, so be sure to subscribe so you know when that video hits. Index Universal Life has some of the same properties as whole life and universal life, but there are significant differences in the structure and uses of an IUL. Oh, and before I go any further, there is a fifth variation of permanent life insurance called variable universal life. However, we don't work with VULs, and we think IULs are a much better option for most people. The biggest difference between whole life, universal life, and index universal life are the policy designs based on guaranteed versus non-guaranteed values. Whole life has guaranteed premiums and guaranteed cash values based on 2 to 3% annual returns. The entire contract is guaranteed. They have the most expensive premiums. Universal life has base guarantees like whole life, but the premiums and policy values are based on slightly higher non-guaranteed rates. A universal life policy might base your premiums and cash values on 4% per year, but can only guarantee the base 2 or 3% like whole life. This trust in the insurance company that they'll do a little better than the base will in turn lower your premiums a little bit. With Index Universal Life, the shift of risk goes even further to you. The guarantees of an IUL might be 1% per year, but the non-guaranteed policy values might be based on 6% per year. This is because your policy values are based on the performance of an index like the S&P 500. When the S&P 500 goes up in any given year, your policy values participate in those gains. When the S&P 500 goes negative, your policy values and any gains in previous years are protected from losing money, i.e. you get a 0% rate of return. IULs also allow you to overfund premium payments to pay more than the recommended premium amount. These are called max fund premiums, and they go directly into your participating index. If the policy value does well enough over time, your cash value can grow significantly, allowing you to use the benefits of your life insurance policy while you're still alive. We'll explain how all this works in much greater detail on our deep dive video, so again, be sure to subscribe so you can catch it. Thank you so much for joining me for today's lightning fast lesson. It means a lot that you took the time to watch this video. If you like what you heard, go ahead and give me a thumbs up. For Maz Income Planning Services, I'm Jed Maslowski, and I'll see you next time. Cheers.